it's the greed reflex. People will get sucked in the greed reflex. It's going to give you convenience, all of these aspects, and then suddenly you can get rug pulls. And globally, the banking system has a history of that. You are, through inflation and banking charges already being slow whittled, we're going to have a full-blown rug pull.
This is Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for July 4th through July 11th, 2023, while supplies last. This week we featured 2023 Silver Philharmonics at $3.79 over spot, and Ital Preziosi 10-ounce silver bars at just $2.79 over spot per ounce. First, frequently regarded as one of the most beautiful sovereign coins, the Austrian Philharmonic portrays instruments from the Vienna Orchestra on one side and the grand pipe organ from the famed Augsburg Golden Hall on the other, all in 3/9 fine pure silver, with a face value of €1.5. These 2023 Philharmonics come 20 to a tube, 500 to a box, are just $3.79 over spot, and are IRA eligible. Next, our Ital Preziosi 10-ounce silver bars not only maintain a great level of liquidity, but also boast one of our lowest premiums in months, at $2.79 over spot per ounce. They come individually numbered, are available in any quantity, and come 50 to a box. Both our specials this week are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Francis Hunt, the market sniper. Francis, thank you so much for joining us today.
Always a pleasure, Elijah. Thank you for inviting me.
Well, it's great to have you on today. We are definitely seeing not a very interesting precious metal market right now. We've seen a bit of a pullback, but it is interesting because we're still, supported near all-time highs here. Can you share with our viewers your analysis right now of where we are in the gold market?
Absolutely. Let's go to the charts. In parallel markets, we've highlighted that both the crypto market we feel has turned and the gold market is clearly in a bullish phase. And I also want to emphasize none of our forecasts are affected by this, because we've come on with you before and said we are expecting the 2,905 run. I'm just getting the gold chart up to highlight where we are. I'm going to just take the eye off initially and bring it up for you. So all those points remain in terms of our optimism for the precious metals, Elijah. We just think you're kind of in a holding station right now as the market's sort of dealing, maybe it's peak rates, maybe it's all these aspects are now taking hold. And in actual fact, we're getting a slight technical pullback here. This is nothing too scary. So I'm on gold and I'm on the 12-hour. It's kind of half a day. You're getting this kind of a pullback. These kind of structures typically we call falling wedges, Elijah, on the half day as I've drawn it. And you'll probably you can come a little bit down one more time. So we call them the three impulses. You tend to get very consistently three impulses here. So you get 1, 2, and then you get an up and over one more time. But the next major move to be focusing on is usually an upside break like that in terms of the move. But I don't think that one's going to be the one that rips you past the 2,080. I think you can sometimes, we still got some time to kill, I feel personally, because there's a little bit going on with the expectation of this peak rates. If I just go to the daily and squeeze a bit more space in, what you could do as a scenario is when you break out that falling wedge as I've drawn it, like that, you can see there's tactical buying coming in on the dips. Almost certainly. And when what you could do is after that, you could have a break move up somewhere here, and then again, pause, cap out, and rest again. So typically we would expect some degree of continuation structure to form before we get that move. I don't think you're just going to break and rip to a new high. People tend to be a bit binary sometimes when they think about charts. There's usually a gestation and a winding up period and a triggering event, which will be news driven. So technical is looking at the other side of the coin, fundamentals. The same thing if I look at debts, we see rates actually on the US markets also looking like going up a little bit in the not too distant future. So we don't think this fight on inflation is anywhere near one, and we don't even think they can afford to do the tightening to actually win that fight in terms of the liquidity provision. So they're kind of they're doing a half job. There's a little bit of petrol being kept still going on the one side of the fire and a little bit of watering the other end, but all they're doing is walking it along. They're not dousing it with a full-on assault. And I think people get the impression that they are. However, in spite of that, your consumer, when you look at that GDP numbers, is really hard hit. Things are still expensive. The fact that things are still going up, but not as much off a very high base, doesn't mean you're winning the battle on inflation. It just means the rate of acceleration. It's me and the Porsche Turbo and the Autobahn. Just because I'm doing 250 kilometers and still going faster, but not at the rate when I was in first and second gear, doesn't mean I'm not getting up to some ungodly speed. So there's a second derivative there. The acceleration aspect of it may be rounding out a little bit, but the collection of momentum and speed is still there. So anyone running after and trying to jump on board is finding themselves further and further behind. So a couple of concepts there. If we just go up to the bigger time frame, because this is the reminder of the macros, which we will reiterate, and we still actually feel very strongly is happening. Might get a bit busy with lines when I do this, but this is the big fat line over there is our bear flag break. And what's very typical of a key level break is you just revisit down. So we've essentially done that again, and I'll overlay draw it because that's kind of very busy there. We work a lot on the gold charts, but in that structure that we have there, it's very common to do that. And I'll also highlight the three touches and resistance, and the fourth is the break. And previously, when you touched up there, you came really hard back. But in actual fact, we're having quite a bit, we are slipping, but there's quite a bit of hang time. And as I showed on the falling wedge, and I pointed out on the lower timeframes, there's bid coming in there. So this is more a holding area for a light volume period, in my overall opinion. And I'll also remind of the $1,000 mark. The $1,000 mark, you hit once, you hit twice, you hit three times, and then you blasted through, and you literally ran to the next $1,000 mark, the 2,000 mark, before you rested. And now we're at the $2,000 mark, and you're hitting once, you're hitting twice, you're hitting three times. And I think each time, the first knockback was huge. That was, of course, subprime, and then lesser and lesser. And I think this is going to be the least aggressive knockback, and then a coiling up point here that will see us then continue our move to the 2,905, which is quite interesting because that takes you to the doorstep of 3,000 in much the same way as this structure just under the 1,000 mark took you to the doorstep of 2K before having a big cupping structure. And I don't think we have the time for this decade, this lost decade almost for gold anymore in the current hyperbolic period. But that's a big cupping period, and many will want to say that's a handle to that. I don't mind how you carve it up, but all of these macro technicals are very, very bullish and positive. So we see the next 1,000 mark coming in, which you may ask, and jump in anytime you like, but you may ask, what's that got to do? How's the gold silver going to play out? And I think we pointed out the gold silver last time when we spoke, that if you're at roughly 3,000 and the gold silver ratio is coming back down, and I think it was when we last looked, we've got again quite a complex amount of drawing here, but this is again a broadening structure is uncertainty on the upside move. It's kind of like a trumpet, megaphone, some will call it. And the main move is this rejection from these extreme highs. So the breaking, we expect this to break at some point. You are starting a little bit of a down move. So the relative valuation. So this is going to bunch up against this lower line, and we see it then revisiting the 65, which was that head and shoulder neckline where this whole thing was a head and this is our right shoulder. and the left shoulders to the right. So if we got down to 65, as I've indicated before, that would take us back up to the $45, $50 silver range, which many people probably are going to be very much looking forward to in the event of this being the breakdown here. I would think you would pause again here before we went right the way to the head and shoulders targets, as I've illustrated in previous versions of our visit. So not a lot's changed on the macro. It's just a case of it's a frustrating time. I wouldn't be a leveraged long trader right now, and certainly not a short one in this environment. But when we start to let go and come back down on this big red line, I'd be watching much more closely. And that could be a time to enter silver and gold, but particularly silver as we move down there, because that's pointing to 45.50. Before I finally hand back, as a very important reminder, Elijah, is that in some senses, the 50, and I'm going to take you to a super high time frame here. We've just shown you 3 times in a break, a couple of times on gold. What I'm going to do is just show the full history of silver. And if we go to that $45, $50 range, I want to remind everybody, and I'll just take recent workings off so that you have a cleaner chart, that this zone is absolutely a seminal zone, this 45, 50 zone. Of course, the 80s, which is when you doorstepped just about 50. I'm not sure what I'll get here. I think it's close to 50. We got around 48s, 49s. If we then get that move on the gold-silver ratio down to the 65, gold to 2,900 gateway, you will be back in there. I'm actually going to advise you could, when we get back to August, September, and we see the move, you could get some low leverage longs if you're a trader, but that you should close them when they get there, because I would expect us to be rejected again there and bring ourselves back down. In much the same way as that gold chart at 1,000 looked. This is just a much bigger version. So if you can recall that gold at 1,000, I'll maybe bring it up again or split the chart for you. But it's very, very similar structures. So there's a little bit of looky-likey in this. Let me do that and put the gold in there so that people can just appreciate. So this is the value of patterns, and what we do is that you tend to get similarities. If you're getting all the key elements of something, they have a tendency to repeat. If I go back and show you that $1,000 gold structure, I might need a longer time frame chart. There we go. I'll just clear my face up a bit there. So this is the 1,000 period when we were in the precursor of 2008. And then I'll just pull this one together a bit more. You can see a degree of similarity. They're different time frames. This is the weekly. Those are the knockbacks, 3 full knockbacks, then very low volatility squeeze, and then that 1,000 level goes. And you know what happened next. You ended up twice. That's on gold, which is a much bigger market, takes a lot more fiat to move. And the argument I am making is gold's 1,000 is silver's $45 to $50. It's zonal. Don't think too precisely, but the obvious round number is $50 in that. So the next move up is $50, but then you will get some degree. If you're a leverage longs, I would take off in the 45, 50 zone on the leverage, but I would turn all profits into investment and buy the dips all the way down on either dollar cost averaging or try pick a low on the basis that the next move is that in terms of the two. So I don't know if that's a technically interesting chart, and I respect I've monologued for a bit here, so to let you back in there.
No, I think that's so interesting to show the similarity there, and obviously you mentioned how it's different time frames, but on a technical level, it should react similarly. Obviously, there's no guarantee ever with technical and analysts, but it definitely gives us a good view of where we could be headed in the short term, or more, I guess, long-term future for silver.
And just to add a tiny bit to that as well, the bigger the structure and the time frame, the more reliable. We're not on 5-minute, 10-minute, 15-minute, hourly charts here. These have been very consistently on balance of probable, reliable. Align the two setups between each other. The first impulse, so the bigger the time frame, the more reliable, and the bigger the move as well. So, you've got that big first impulse, which is very similar to this one. And then what tends to happen is the time frame shorten between each one. If we get that September, August run, and then next thing you know, say Q1, Q2, let's be a little bit presumptuous here and indulge me. We get a run up and then a pullback there. You are seeing that the times in between each event are getting shorter. So that localized high to that localized high is not nearly as long as, you know, the first high all the way to the low and then to the next high. So what tends to happen is you're bored for a long, long period. And then suddenly things start to shorten and then action comes fast. And people get caught by surprise because they've been lulled into, it's like crying wolf. If you're a gold and silver investor, you're sick and tired of the gold bulls crying wolf and saying, now it's going to run, now it's going to run. And eventually you do miss the fact that the wolf does eventually come on some occasions. So if you could get that small wind-up fractal like you did here, you could see there was an additional squeeze. So we focus on the low volatility. And can I make another point? I blogged this on a trading platform and predicted that this was going to lead to a major run in gold. And then I did a thread. September the 2nd was the day. So I don't even have to check this day. I remember it because I was intrinsically, and we called that a breakout. And at the time, nobody thought it was. It was just a move up. It hadn't even traded through 1,000. But because it had traded through our low volatility entry, so let me just tidy that drawing up a bit over here through that third high, that very low vol 3, we were in early. We had super tight stops with leverage, and we were in this run. And the newspapers only start talking it when it starts taking out the previous high, which was around 1,035, that it didn't hold for more than a few days on a wick over there. And you end up getting long. So it's very important. Buying orders, entry levels matter. And if you're using even just conservative light leverage, you may be putting down half the money and you're just getting a doubler or 2.5 times. You've got to have a stop loss. And you've got to know how. This is what we specialize in doing, adding a little bit of amplification, but not too much. But you've got to be in earlier and you've got to have tight risk management. So you can say, okay, that represents 2-3% of my trade idea. What that does is that gives you a great amount of additional weight on the up legs. And that's super powerful and it's very, very predictable. So overall, what I'm saying is super, super bullish. It's just not bullish tomorrow, next week, or even necessarily next month. But we are not too far away from this kind of event potentially repeating. And when it falls big and it runs hard for a lengthy period. And everybody will know about it. So big patterns give big targets. Just final again on that, this target here, you're talking about 50 trading all the way back down to around $3.50. That's almost a $50 move. You know, you're talking about $47 odd there. And we have a projection point that would take you to the gateway of $75-80, which is not too far off your 3-digit mark. And we think that's still happening, you know, in and around the 65 gold silver ratio, with gold or also having moved. Don't forget, the bigger brothers also not going to be sitting on his backside doing nothing during this time. So the message is actually fundamentally positive. And actually, for the smart and the patient and the enduring, these current controlled descents with that bid, I was showing you the falling wedge, are great accumulation points for idle cash. That's sitting in banks where some people are seeing the likelihood of 4,000 banks globally failing as part and parcel of the system. If you're owning that in physical silver and gold, you're in a much better place than everyone else who's just got the rug pulled on them by the mercantilist banking system. So I'll stop with a chart here there.
You mentioned kind of accumulation strategies there. A lot of people are looking for further pullbacks ahead and they're wanting to, you know, place their cash somewhere safe. They're looking possibly like to short-term bonds. Your perspective on places to, I guess, place liquidity, is it just precious metals right now would be the best place, or your perspective on kind of that accumulation strategy of metals? And then also, if you're looking for pullbacks, where do you put funds?
A good question. So first of all, with regards to the debt markets, I simply will not have any form of long position in the debt markets. So it's our overall macro view. This is my own personal principle at Doctrine. Anything that we see that has reversed a 40-year bull market since the 80s, and that is our position as of the March 2020 events, I only trade short or square. So I will not own a debt instrument for all the tea in China for piddly yield. So what happens is we've gone from, and I've used this phraseology before, the search for yield that gave us the era, which was the whole 80s, especially the back half of this 40-year period, where everyone was pushing bonds ever higher just to get an interest draw and leveraging up to make the returns on bonds more interesting, to now a preservation of capital era. And so there is nothing about the values of bonds that gives me preservation of capital feeling at all. And there's nothing attractive about the yields. People think 4.5%, or they can get in the money market, maybe a touch more, is being shrewd. That's like collecting dimes in that same Autobahn that I was describing with Porsche turbos doing 300 kilometers an hour. You may pick up a few dimes and then you may get clobbered so bad it's the end of your game. So the capital preservation part is far more important and gives you your growth. So forget anything. I almost say yield it's almost not non-essential. You'll get immense amount of growth via capital preservation. The other market that I am in, and I'm not a fan of being antagonistic, and I think this is almost an orchestrated message, and I don't have any great trust in it. I prefer gold as something I can hold in my hand. So I think physical assets have preeminence, but I do see a role for particularly the status type crypto tokens to go up. And that's, if you want to play with the devil's system, rather than buying bonds, you may as well play in the new system that they're bringing on the status tokens that at least will give you capital appreciation. And we've figured that the crypto markets have turned. Now, I know there's some people of a certain age group for which that's an anathema, and I understand that. But there will be a role for the likes of XRP, for example, which is literally embedded with all the CBDCs. I think the actual blockchains and various others, and we can technically see which ones are showing relative strength. So we're not driven by just news, data, and funny stories, which a lot of the crypto market is as well, and misinformation. But obviously be careful. There's counterparty risks if you're using centralized exchanges. We've already felt that. So be careful how you acquire. You can use wallets. And especially if you're new and you're untrained, don't use any leverage because these are much higher volatility instruments. We do occasionally under very controlled circumstances and being highly trained. Just keep it tidy. Don't let the greed genie grab if you want to participate in that, or go and see our website and find out what we're doing, or follow us on YouTube.
Now, you mentioned how, for example, in bonds right now, it's not, your philosophy is don't touch them at all. We're actually... One of the reasons for this, it seems like, is because we're entering into a new system. So people have trusted for so long, U.S. bonds, they're the safest assets. You could lose everything right away in your view. Can you expand on that and kind of if you wanted to briefly discuss the kind of the end of empire? You've mentioned how as countries move away from sound money, the system ends, it seems like. So can you expand on that?
Yes, sure. Let's deal with the first part of your question, which is just further on the bonds. So it actually, once initially you set out to learn about everything and be engaged in everything to learn and grow. And then it becomes more about what you eliminate that you will not do, and you become a specialist. So the surgeon earns more than the paramedic, potentially, although they both can do pretty well. The concept is the specialization of realizing what not to do is almost more important. Does that mean that some people, if I say don't be in bonds at all, does it mean that somebody couldn't have a 3-month spell or a 6-month spell or a 9-month spell and actually get moderate yield and even a bit of capital appreciation during a fear period? Absolutely, they could. The question is always one of risk reward. If you saw the chart that I was showing you when I showed our entry on this September the 2nd, that was the day, that was 2009 or 10, I think it was, the year when we literally got very early entries on a very quiet, boring market as traders were getting back to their desk in September, way back then. That's now almost 15 years ago. Our risk was very limited and the reward was expansively high. With the bond trade at end of cycle, essentially, you are chasing the exact opposite. Very small potential rewards. You're going to brag about your 4.5% per annum. That means you need an entire year to pick up 4.5% in an inflation rate which is being understated. Again, John Williams, and go and see that. I mean, that's about saying your currencies, your holding of currency has gone down a small amount less than anybody else's. In these kind of inflation-led times, actually, if you're not making 15 or 20%, you're probably going backwards. And you have to take a small amount of risk to do that. If we look at the TLT, which is a popular ETF for bonds, I want to highlight how it is technically set as further argument for why I would say the debt markets are just not one to be engaged in right now. So I'm going to go back to the charts and just share that screen again. And this is a very common proxy for long-term 20-plus year Treasury bond ETF. And this, if I flick the eye on real quick, you'll see we had a huge head and shoulders. The blow-off peak was March 2020. We all know what was going on there. And that also coincided with the blow-off peak in the gold-silver ratio. So you had peak undervaluation of the capital preservation metals complex, and you had complete supervaluation of the debt markets during that event. Everyone was chasing into debt, and to the point where it was yielding not even a fraction of a percent. We then got this head and shoulders. We broke and we absolutely smashed it down to target. And this is a seminal bull market event, turning event that actually goes right the way back to the 80s. So this is all bull market into here with a blow-off, a final blow-off. Markets end on blow-offs. And then it got turned. So yes, you made that target. We were short this from early on up top here, this ETF, right the way to target. And since then, you've gestated for a while. You're not getting much carry or benefit so far. But longer run, this is a cyclical head and shoulder. And you don't just make the target, it's a trend change event, which means you will start in due course trending further down. Now, I've learned that every time I've tried to trade a market in both directions, zig and zag, I've ended up blowing myself up. And I also get a bit of confusion as to what my core bias is. So when my core bias is bear, I'm either neutral and not engaged, not involved, no active trades or investment positions, or I'm short. When a market is bullish, I don't try trade a rally, for example, because these rallies often end abruptly and go into chronic spills. Because you're trading against. You're trying to paddle upstream, in essence, and be too smart. And I avoid being too smart. When I look at the lower time frame, and this is still weekly, I've seen 3 resistances on this, the long-term bond market. Right there. And then back down. And now you're getting this weak attempt here, very flag-like, and rolling over to the downside. That is bearish for values. Remember, this is not the yield. This is the values of long-term debt. And we are also, haven't mentioned this in a while, super overextended on the yield curve inversion, which points to an even greater reset. It's almost I can almost say, as far as you can, I'm 95% certain that the events that will come out of the reversion of that yield inversion is going to be the biggest economic event of our time and make up part of the reset, which is also why simultaneously I'm getting into the status tokens that are likely to appreciate for this new world financial system that they're doing. Unfortunately, I can't stop it. So you may as well profit from it.
Fantastic. And I think the last thing I wanted to discuss with you was kind of how you see this kind of end of empire, I guess, reset playing out, because you also have recently mentioned how with Sparta, many centuries ago, many millennia ago, we saw that the government went to a fiat money standard, and this was one of the reasons why the system collapsed there. And a similar thing could be happening today.
Yes, it's very interesting study of history. And as I say, I'm early doors and learning, and I find it fascinating. I'll just share a few anecdotes because people love narratives and stories. The Spartans were great warriors. You will remember that from the movie 300. and they lived very simply. Some even the leaders, they had sort of communal eating halls. They ate very clean and very basically. They wore the same things. They weren't attracted by bright, shiny things and baubles. And they were a warrior nation, and they would be trained in warriorship as part of their manlyhood, the men, and the women as part of the support system around that. And they resisted the mercantilist banking cartel immensely. That was a traveling caravan that would bring bright, shiny silks and baubles and everything from the other world, and also were responsible for lending, usury lending, that led to the downfall of the Roman Empire and many others during different periods. And they had a very strong philosophy, and they kept iron, large, heavy blocks of iron as their money. And they actually decreed that their money, you should not use death if you used any other system's money, because the mercantilists were trying to penetrate Sparta with their usual temptations. And I'll cover those in a moment. And Sparta resisted this and was a very fierce fighting force for a long, long period. And eventually they started to turn to coinage, and they started to soften. And they got some coinage in, and they got debt. And the minute the money lenders got in and started getting them debt, they started getting coaxed into more wars. And the minute they got coaxed into more military conflicts, because the caravans of mercantilist money lenders essentially were also the breaking news. They would say, your neighbors are arming up. The people to the left of you are getting technology to fight you and attack you. So they also could create fear. So this warns of media as a creation of fear, and that they suck you into preparation for wars. And they got sucked into a lot of wars once they started issuing coinage. They also started to have the usual other things put to them, which they initially resisted but slowly folded. But because of the wars, a lot of the men got killed. So they ended up with a very feminized, the wealth, 40% of the wealth were with widows whose husbands had died, because they obviously inherited the wealth. And they started to be attracted by the silks and the baubles, and they started to buy that. And then the feminization, the offer of progress as business plan, you should do this. This is more progressive. Conspicuous consumption started to come in. They used to eat very simply and live very simply. Now it was like luxuries. Alcohol made it into the system, and debt was the beginning. When they first started to introduce coinage, the money lenders put advisors in, started to get them into debt. There was even clay images of sexual nature. That was essentially porn of today. That was bringing in that, a little bit of perversion, keeping younger boys, all of that sort of stuff. And opium dealership, which was already a product very many, many, many years ago. And that undermines and destroys culture. And then immigration into Sparta. Sparta was very homogeneous. They were all Spartans, and there was an esprit de corps, and everyone kept together. It's not a popular measure right now, but actually strong, bound by similar principle societies were able to resist for an extended period. The minute they had lost that, they were destined to fail and fall. There's a lot more that I could say on those aspects that undermine them. For example, the destruction of the family unit, loss of the men because of the too many battles, the divide and conquer by gender, race, and generation. We're seeing quite a lot of that today. And also adding a new ideology that even if the old people reject, the new generation to push against their parents will be more amenable to. Changing the definitions of democracy. I just mentioned how we changed the definition of a recession. So democracy was a Greek word, and it meant certain things. You start to change definitions. So you remove the basis of comparison in statistics and in language. So, and we've seen that also on injectable medical treatments. I'll try avoid saying the word. That's been redefined recently. You introduce derivatives of money. What people don't understand is that when they started not holding their gold anymore, they gave clay plates that were baked for you to say that the money lender was holding your gold for you and was issuing coin. The money lenders did essentially what we call in crypto rug pulls. They would eventually disappear. They did their magic disappearing trick with the gold, and you'd be left holding a clay entered, and we saw a lot of pre-World War II banks that went under and took entire families' wealth. So across all Benignan, you've come across the same mercantilist rug pull, but the first game is derivatives. Now, when I listen to, this is a really interesting discussion, when I listen to Fink of BlackRock, it might be Larry, I'm not sure what his first name is, and he was talking about blockchain. I listened super carefully because I'm surgically to the words they use. And he wasn't praising any particular token. He didn't say Bitcoin's going to go to the moon or we're all in on Bitcoin. He was talking about the blockchain, in other words, the railway system. This is very much, this turns into Rockefeller and Rothschild of America, the owning of the grid, the Rockefeller system. And he kept stating, and I kept noticing this, and declared beneficial owners of tokens within the blockchain system. So what he actually wants is complete transparency of who owns what, all on a decentralized, but there's no such thing as decentralized as far as I'm concerned. Everything ends up on a Amazon server, a Microsoft server. When you put things in the cloud, at the end, the wholesaler who's providing the hosting is one of 3 or 4 companies that are all co-opted, in my opinion. So in essence, they sell you this decentralization as a dream. It's a bit like Santa Claus. It's a bit like Satoshi Nakamoto. So I'm quite cynical inherently. But the key element that he was excited about as a tax extractor or working for the tax extraction mechanism is that everybody is declared as a beneficial owner on the grid. So what you actually have is a global clipboard with all your assets captured and your name and place and which corporation you fall under, the Corporation of the United States of America, the United Kingdom, or whatever. So extraction and identification becomes very, very broadly available online, like online banking, which is open source. So it's more about the power that gives them. And again, you get offered a token and an NFT. And we know the future wants to have your property, your physical property, not just the home you live in, but cars and other things, tokenized and put on the blockchain. And what that means is if I proliferate CBDC money, I can outbid you on your own home and purchase your token and thereby declare myself as the new owner via derivatives, control the underlying physical asset. Now, people that are in the precious metal markets will immediately be thinking of the derivative markets and the underlying valuations on gold and silver when I do this. So blockchain will introduce a new derivative system. And one of the key points I put it out was that started with clay. Pieces of clay, when you handed over your gold and said, but you could be stolen, leave it with us. We the caravans, we have armies, we have guards, we watch it, it's safe with us. You have your clay thing and you trade a few times and you get your gold back each time. Then you think it's fine. You start putting more of it. You're getting more pieces of clay and then boom. There's a lovely Bitcoin meme with a guy, who sits against the roller door and puts his wallet down and the guy just gives him 4 times the money. The door lifts and gives him 4 times the money. He thinks, wow, that's great. And then he takes his watch off and everything and draws out all his cash and puts it all down by the roller door and it gets taken. And then he's waiting and and then nothing happens. But it first happens 2 or 3 times that he's getting extra money. And it's the greed reflex. People will get sucked in the greed reflex. It's going to give you convenience, all of these aspects. And then suddenly you can get rug pulls. And globally, the banking system has a history of that. You are, through inflation and banking charges already being slow whittled, we're going to have a full-blown rug pull if you don't own some physical and do not allow it to become derived, that your ownership is recorded and derived upon, because you are now open source declaring yourself, your position and your assets, and they will write laws. So there's already been a discussion document on Ethereum with a Chicago professor where everyone's property should be registered. You pay tax on its valuation, which you declare. And if you deem to not have declared it sufficiently valuable, someone can immediately transact and purchase that token and thereby become the owner. And that's how you will own nothing and be turned into a tenant in your own home. And I wish to resist this force, but I am watching how the likes of BlackRock CEO speaks. And it's historic. It's not even new. We think these are new. It's new tools. It's technological tools. It's more global. Its reach is ever further. And the ease and simplicity is going to be easier than it ever was before. But the tricks are the same. You're getting repurposed tricks of generations, millennia, being brought to you to undermine societies. And I've given you one example of a really resolute society that was brought down in the end because they made minor concessions that led to major concessions that led to indebtedness, contractual obligation, etc. And the advisors and the bankers and the tertiary extractors get in. They bring the inversion, perversion, the porn, the rest of it, and your culture is undermined. The men get slaughtered in unnecessary wars, etc., in the name of getting resources to pay back tertiary debt. Anyway, so that's probably more than you asked for, but it's very interesting history, and it comes with a warning for what's in the future. Own it physically, and if you're going to come to a point, Elijah, where you're going to have to go dark on that, in my opinion, there's going to be some sort of decree of obligation. A man with a clipboard comes, and that doesn't necessarily mean a man with a clipboard at your door. It may mean the blockchain and an NFT token, and it'll be sold to you in the name of convenience, that you can easily sell it off, and the obligation is owned and can be custodially held by reliable people. You'll be sold that dream. That is your merchant banker, the caravanners that disappeared with gold. Watch out.
It is interesting, all the parallels you mentioned there. And yeah, it's just really important to, in your own life, live based on reality, what is real. I think that's so good. And one of the ways, obviously, in your financial life is to look at precious metals. But Francis, before we let you go, where can our viewers find you online if they're interested in learning more?
Absolutely. So we have a big gold and silver community that are consistent stackers. Themarketsniper.com is the website. If you just want to keep an eye on us and you're not sure if you like us, watch us on the YouTube. We've been running that channel since 2009. And, we give advice on the markets, generally traditional markets, and you can follow the Crypto Sniper if you're interested a little bit in what's going on in our views on which tokens are likely to outperform as well. So our core emphasis, Elijah, is how do you build wealth and secure that wealth to survive a key turning of system, where the goal actually by the system is to impoverish everyone into a peasantry class. So it's a very big challenge. You've been chosen for that challenge because you can handle it. Be smart, prepare, and that's what we are doing, and we're going to come out winners.
Fantastic. Francis, once again, thank you so much for your time, and God bless.
Same to you, Elijah. Thanks for having me on.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.